Hello, everyone, and welcome to today's daily analysis. Today is the 28th June 2024, and here are key things you need to know. For the US dollar today had a bit of a roller coaster this week. After a starting week, it picked up and rose to 105.78 on Tuesday. This came despite a slight drop in consumer confidence. Earlier in the week, the dollar dipped to 105.4 as investors cashed in their gains from a steady rise since May. The US economy is showing mixed signals. There are some signs of deflation, but the Federal Reserve is playing it safe and haven't started easing the policies yet. This cautious approach keeps everyone guessing about what's next. For the third week in a row, the dollar has been getting stronger. This is thanks to better than expected economic data and continued tough talk from the Fed. Currently, the dollar is at 105.46 and still showing signs of strength on the daily chart. As we approach to the end of the month and half year, we might see some unpredictable price movements due to the fund flows. Also, the Friday's US presidential debate could stir up the foreign exchange and the interest rate markets. Technically, the things look good for the dollar. The key indicators like the RSI and MACD are positive, and the dollar is staying above important moving averages. If it stays above the 20-day moving average of 105, we might see it rise further. The key levels to watch are 104.8 and 104.47, which are important support points. The oil prices had an interesting start to the week. They went up on Monday, but then dropped as traders took profits. Adding to the mix, the Republic of Congo increased its oil supply, which influenced the market. At the same time, the US dollar index was above 105.5, and European stocks created some risk aversion. On Tuesday, WTI crude oil prices hovered around $81. There's a lot of talk about strong oil demand for the summer driving season, especially with ongoing tensions in the Middle East. These factors are pushing oil prices higher. However, a strong dollar and a cautious Federal Reserve could weigh on oil prices. On Monday, San Francisco Fed President Mary mentioned that the interest rate cuts shouldn't be cut until inflation is clearly moving towards 2%. Higher rates usually mean higher borrowing costs, which can slow down the economic activity and reduce oil demand. Looking at the daily chart, oil prices are stuck in the growth area just above $81. They are slowly climbing to $81.5, but might hit a familiar resistance level soon. The current bull market area is above 200-day moving average of 79.04 and the key psychological level of $80. If prices break above 82.12, we could see them move towards 83.5 and 84.14, the high from April 26. On the downside, support levels to watch are 80, 79.04, which is 200-day moving average, and 78.33, which is 38.2% Fibonacci retracement. Last, we have the gold prices, which has been on a bit of a seesaw lately. The drop to $2,220 during the US session after hovering around $2,230 yesterday. This dip came as the 10-year Treasury yield stayed above 4.2%, and the dollar bounced back thanks to some hawkish comments from the Federal Reserve. On Monday, gold saw some gains, but they were quickly erased as market risk appetite increased early Tuesday. The dollar had fallen along with Treasury yields after some dovish markets from the Fed officials, which initially helped the gold prices recover. However, the dollar's renewed strength put pressure on gold again. Gold managed to climb back to around $2,335 briefly after the Euro USD recovered from a 6-day low, but sellers quickly pushed prices down again. Despite the dollar's continued weakness and falling treasury yields, gold prices have been under pressure as traders await Friday's US inflation data for hints on future interest rate cuts by the Fed. End of the month fund flows could also impact gold prices trends. Technically, the gold prices are maintaining a symmetrical triangle pattern, rebounding from the support level at $2,320 on Monday. However, the 14-day RSI is below 50 at 48.95, indicating bearish pressure. A death cross between 21-day and 50-day moving averages is also putting downward pressure on gold. If the gold prices close below the 2220 support line, it could confirm a breakdown of the symmetrical triangle, pushing prices towards 2210 and then 2300. If the prices drop further, 2277 will be the next key support level. On the upside, gold needs to break above the confluence level near 2335, where the 21-day and 50-day moving averages meet. If it does, it could aim for the upper resistance of the symmetrical triangle at 2358, which is a significant obstacle before reaching the Friday swing high near 2368 to 2369. And that is all for today's daily analysis. Thank you for watching and happy trading.